You're checking your portfolio. Again, it's up another 2% this week. Your 401k is at a number you didn't think you'd see for another 5 years. Everything feels good. And then you see the headline. Goldman Sachs just published their 2026 outlook. Target, 7,600 on the S&P 500. That's about 11% total return when you include dividends. But here's where it stops you cold. Buried in the same report, they mention the market's Shiller PE ratio. The one that smooths out 10 years of earnings just hit 40. That's only happened twice before, in 155 years, 1929 and 1999. Both times, the decade after was brutal. You close the app, but the question stays with you. Is this the top? I'm Ben, and this is Ben's Money Milestones, where we look at what the numbers are actually saying, not just what the headlines want you to feel. Let's start with what Goldman Sachs is actually saying. The headline? S&P 500 target of 7,600. That's about 11% total return when you include dividends. Their math, S&P 500 earnings growth of 12% in 2026, plus dividend yield of 1.5%. Sounds great. That's above the historical average. But here's where it gets interesting. That 11% return isn't coming from valuations getting more expensive. It's coming from earnings growth only. Goldman is quietly assuming the market's price-to-earnings ratio stays flat, or even compresses slightly. Translation, they think companies will make 12% more profit, but the market won't get more expensive. It might even get slightly less expensive, which means if earnings disappoint or if something spooks investors, that 11% could easily become 5% or 0. Now here's the part that should make you pause. The current CAPE ratio sits at 39.7. The long-term average since 1871, 17.3. We're trading at a 130% premium to historical norms. When you buy the S&P 500 today, you're paying $2.30 for every dollar of value that historically costs $1. And here's the pattern Goldman is not highlighting. In 1999, the CAPE ratio hit 44. Over the next 10 years, the S&P 500 returned negative 1% annually, a lost decade. High valuations don't predict crashes, but they do predict one thing with mathematical certainty: lower returns going forward. When you start from expensive, there's not much room for things to go wrong. There's a woman in Denver. Her name's Rachel. She's 44, works in marketing, makes about $92,000 a year. After taxes and deductions, she's netting around $5,100 a month. Between rent, car, and essentials, she's spending about $3,230. She's been putting $1,200 into her brokerage account every month for 3 years. Her portfolio up 68%. She's sitting on $58,000 now. She reads Goldman's report, sees the 7,600 target, but then sees the CAPE ratio at 40, and she realizes something uncomfortable. Her entire plan assumes the last 3 years are normal. Here's where this gets real. Rachel's retirement spreadsheet says if she keeps contributing $1,200 a month and gets 8% returns, she'll have $1.2 million by age 60. But if the actual return is 4%, because we're starting from a CAPE of 40, and historically that's what happens from these levels, she hits 60 with $870,000. Same contributions, same discipline, but $330,000 less. That's not a rounding error. That's the difference between retiring at 60 or working until 64. And it all comes down to one thing: the price you paid at the start. Now, Goldman has a counter-argument worth understanding. They point out that the Magnificent Seven, Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla, are trading at forward PE ratios around 29. During the dot-com bubble, comparable tech stocks were at PEs over 50. So yes, it's expensive, but it's not .com insane. And the earnings growth they're projecting is real. These companies are printing cash. They're not pets.com with no business model. Goldman's also pointing to specific drivers: U.S. GDP growth around 2.6%, AI moving from infrastructure spending to actual adoption, and international markets starting to close the valuation gap with the U.S. All of this is constructive. All of it suggests the bull market has room to run. But here's what they're not saying loudly. Goldman's forecast of 11% has a range. Best case, 17% return if everything goes right. Worst case, 4% if we hit bumps. That's a 13 percentage point spread. And buried deeper, they estimate a 1 in 3 chance of a recession in 2026. So they're forecasting 11% returns while simultaneously saying there's a 33% chance the economy contracts. That's not a prediction. That's risk management theater. Here's what that means. Goldman publishes these reports because their institutional clients, pension funds, sovereign wealth funds managing billions, need narratives to justify their positions. The report serves two purposes. One, give clients something to point to. We're staying invested because Goldman projects 11%. Two, provide cover if things go wrong. We flagged recession risk on page 73. It's preemptive blame management. Institutional investors don't get fired for following Goldman's advice, even when it's wrong. They get fired for ignoring it and being wrong. Rachel spent 2 weeks processing this. She didn't panic. She didn't sell everything. But she made 3 changes. First, she adjusted her allocation. She'd been 90% stocks, 10% bonds. At 44, with a CAPE ratio at 40, she shifted to 75% stocks, 25% bonds. Not because she's timing the market, but because she has less time to recover if things go sideways. Losing 30% at age 30 is annoying. Losing 30% at age 58, that can end your retirement plan. Second, she ran a stress test. She changed her retirement calculator from 8% returns to 4%, then looked at the number. At 4% returns, she can still hit her target by age 62 if she works 2 extra years and increases her monthly savings from $1,200 to $1,400. Not ideal, but doable. And knowing she has a plan B gives her peace of mind. Third, she took $300 of her monthly $1,200 and redirected it to an international fund. Why? For the first time in 15 years, international markets are showing value. Europe's CAPE ratio around 15, Asia around 18. The US is at 40. That's a massive valuation gap. Rachel's not abandoning US stocks, but she's not betting everything on one market staying expensive forever. Here's the framework I'd use to think about all of this. Goldman's not predicting a crash. They're predicting a grind. Positive returns, yes, but lower than what we've gotten used to. More volatility, more uncertainty, and a market expensive enough that there's not much margin for error. If you're under 35, this doesn't change much. Keep contributing, stay disciplined, you have decades. If you're within 10 years of retirement, this matters. Sequence of returns risk is real. Retire into a downturn and your portfolio can get permanently impaired, even if the market recovers later. And if you're somewhere in the middle, like Rachel, like maybe you, here's the move. 3 things. 1. Stress test your plan. Take your retirement calculator, change the return assumption from 7 to 8% to 4%, then look at the number. If your plan still works at 4%, you're fine. You have breathing room. If it doesn't, you have a math problem. The solutions are save more, work longer, or spend less. Those are the only levers. 2. Adjust your allocation based on your timeline. If you're 45 and still holding an 80-20 stock-bond split from when you were 30, recalibrate. Not because the market's crashing tomorrow, but because you have less time to recover if it does. Losing 30% at age 30 is annoying. Losing 30% at age 58, that can end your retirement plan. 3. Geographic diversification. The U.S. market is expensive.
International markets are cheaper. Taking 20 to 30% of your equity allocation and putting it in international funds, that's just acknowledging that paying $2.30 for a dollar of value in the US versus $1.20 in Europe matters over time. Here's what Goldman's report is really saying underneath all the charts. Markets are expensive. Risk is elevated. The next decade probably won't match the last decade. But that doesn't mean panic. It means adjust your expectations, stress test your assumptions, and recognize that the price you pay today determines your returns tomorrow. And stop assuming the last 3 years are the new normal. When the CAPE ratio is at 40, it's saying the price you're paying today already assumes a lot of good news. If anything goes wrong, or even if things just go normally, there's not much room for error.
That's not doom and gloom. That's just math. Here's what matters for you. The question isn't, what does Goldman think will happen? The question is, what happens to my plan if Goldman is wrong? And if the answer makes you uncomfortable, then your allocation is wrong. Not because Goldman's forecast is wrong, but because you're not prepared for the range of outcomes that's actually possible. Rachel's plan now works in 3 scenarios. If Goldman's right and the market does 11%, she's ahead of schedule. If the market grinds at 6-7%, she still retires at 62, maybe 63. If we get a recession and the market returns 2-3% for a few years, she works until 64, saves a bit more, and still hits her number. She's not hoping for one outcome, she's prepared for 3. That's what this is really about, not predicting the future, preparing for multiple versions of it. Goldman's report is 103 pages, but the actual takeaway is simple. Markets are expensive, returns will probably be lower, and risk is elevated. And the people who do well won't be the ones who timed the top perfectly. They'll be the ones who stayed disciplined, rebalanced appropriately, stress-tested their assumptions, and built a plan that works even if they're wrong about the timing. Because timing is the thing you can't control. What you can control, your allocation, your savings rate, your expectations, and whether you're building a plan based on hope or based on math. If you found this useful, there are more breakdowns like this coming. We're looking at the patterns in the numbers, not the hype, just what the data actually shows. No panic, no promises, just the reality of what happens when everyone's paying premium prices and hoping the music doesn't stop. See you in the next one.